Picture this. You worked for 32 years. Maybe it was the school district. Maybe it was the fire department. Maybe it was a manufacturing plant with a union contract. And when you finally retired, you felt something most people only dream about: security. Because you had a pension. Every month, like clockwork, that deposit hits your bank account. It is reliable. It is steady. It is yours. Then one April, you sit down to do your taxes, or your preparer does them for you. And the number on the screen makes your chest tighten. You owe $4,000. You stare at it. That cannot be right. You had taxes taken out of your pension. You saw it on every statement. How can you possibly owe $4,000 on top of what was already withheld? And then your preparer says something that stops you cold. Your pension is pushing your Social Security into the taxable range. And your withholding was set at the default rate. It wasn't enough. $4,000. Or due in 2 weeks, plus a penalty for not paying enough throughout the year. And the worst part? This could have been completely avoided if someone had explained how the IRS actually treats pension income. That is exactly what I'm going to do today. I am June. I am a senior policy analyst and retirement finance expert. And this channel, Retirement Tax and Law Pro, exists because the rules that govern your pension, your Social Security, your taxes, and your retirement security are complicated. They are buried in government publications that most people never read, and the mistakes they cause are expensive. Today I am going to walk you through exactly how the IRS treats pension income differently from every other type of retirement income. I am going to show you the traps that catch retirees every single year, and I am going to give you the specific steps to protect yourself, but I need you to stay with me until the very end. Because the last thing I am going to cover is a trap that hits people after they lose a spouse. It is called the survivor's tax penalty, and it is devastating. Most people do not find out about it until they are already in the middle of it. Let us begin. Before we go any further, I want to tell you about a man I will call Carl. Carl retired at 63 from a county government job. He had worked there for 28 years. He had a pension that paid him $36,000 a year. He also started collecting Social Security at 62, which gave him about $18,000 a year. His wife, Linda, was still working part-time. Carl thought he had everything figured out. His pension deposited automatically. His Social Security deposited automatically. Life was good, but Carl made 3 mistakes. Not big, dramatic mistakes, quiet ones, the kind nobody warns you about. Mistake number 1, Carl never submitted a Form W-4P to his pension plan. He did not even know the form existed. So his pension was withholding taxes at the default rate, which is single with no adjustments. Carl was married. The default was wrong for his situation. Mistake number 2, Carl assumed his pension was taxed the same way as Social Security. He thought part of it was tax-free. But Carl had never contributed after-tax dollars to his pension plan. His employer had paid the entire cost. That meant every single dollar of his pension was fully taxable as ordinary income, all $36,000. There was no tax-free portion. Mistake number 3, Carl did not realize that his pension income was pushing his Social Security benefits into the taxable range. Before the pension, his Social Security would have been tax-free. But with the pension added to his income, up to 85% of his Social Security became taxable too. When Carl filed his taxes, he owed over $3,000, plus a penalty for underpayment. Carl was stunned. He had never owed money at tax time in his entire life. Carl's story is not unusual. It happens to pension recipients across this country every single year, and it happens because nobody explains how differently the IRS treats pension income. Let me explain it now. The first thing you need to understand is this: the IRS does not treat all retirement income the same way. Social Security has its own set of rules. IRA distributions have their own rules. Roth accounts have their own rules. And pensions have their own rules. They are all different. Let us start with the most fundamental difference. Social Security benefits have a special formula. Depending on your total income, 0%, 50%, or 85% of your Social Security can be taxed. Many retirees whose only income is Social Security pay no federal tax at all. The IRS gives Social Security a preferential treatment that pension income does not get. Pension income gets no such treatment. When you receive a pension payment, the IRS treats it as ordinary income, just like wages, just like a salary. It goes straight into your adjusted gross income, every taxable dollar of it, at whatever your marginal tax rate is, 12%, 22%, 24%. There is no special threshold. There is no partial exclusion. It is fully taxable. Now, there is one important exception. If you, the employee, contributed after-tax dollars to your pension plan during your working years, meaning money that was already taxed before it went into the plan, then a portion of each pension payment is a return of your own money. That portion is tax-free. This is where the simplified method comes in. The IRS provides a worksheet called the Simplified Method worksheet. You can find it in the instructions for Form 1040 and in IRS Publication 575. This worksheet takes your total after-tax contributions, divides them by the expected number of monthly payments based on your age when payments began, and gives you a fixed monthly tax-free amount. That tax-free amount stays the same every year, even if your payment amount changes. Here is the critical point. You have to use this worksheet. It is not automatic. If you do not calculate the tax-free portion yourself, or if your tax preparer does not do it, you will pay tax on the full amount. You will overpay every single month for the rest of your life. And here is the flip side. The total amount you can recover tax-free over your lifetime cannot exceed your total contributions. Once you have recovered all of your basis, every payment after that is 100% taxable. If you do not track this and you keep claiming a tax-free portion after your basis is fully recovered, you are underreporting your income. And the IRS can assess penalties and interest. So how do you know if you made after-tax contributions? Check your Form 1099-R. Box 9B may show your employee contributions. If it is blank, call your pension plan administrator and ask them directly. This is your money. You have the right to know. Now let me explain something that catches more retirees off guard than almost anything else. I call it the cascade effect. Some financial professionals call it the tax torpedo. Here is how it works. Social Security benefits become taxable based on something called provisional income. Provisional income is your adjusted gross income plus any tax-exempt interest plus 1/2 of your Social Security benefits. If your provisional income exceeds certain thresholds, your Social Security becomes taxable. For a single filer, if your provisional income is between $25,000 and $34,000, up to 50% of your Social Security benefits may be taxed. If it exceeds $34,000, up to 85% may be taxed. For married couples filing jointly, the thresholds are $32,000 and $44,000. And here is what makes these thresholds so punishing. They have never been adjusted for inflation, not once. They are the same numbers from 1993. Which means more and more retirees hit them every year. Now think about what happens when you have a pension. Your pension income goes directly into your adjusted gross income, every dollar of it. And that pushes your provisional income up, which pushes more of your Social Security into the taxable range. Let me give you a real example. Imagine you are a single filer. You receive $22,000 a year in Social Security. If that is your only income, half of it, $11,000, gets added to your other income, which is $0. Your provisional income is $11,000. That is well below the $25,000 threshold. Your Social Security is completely tax-free. Now add a pension of $24,000. Your provisional income becomes $24,000 plus $11,000. That is $35,000. You just crossed the $34,000 threshold. Now up to 85% of your Social Security, potentially $18,700, can be included in your taxable income. Your pension did not just get taxed itself. It caused your Social Security to get taxed too. That is the cascade effect. And most retirees do not see it coming until they get the tax bill. The IRS provides a worksheet in Publication 915 that walks you through this calculation. They also have a free online tool called Are My Social Security or Railroad Retirement Tier I Benefits Taxable on their website. I strongly encourage you to use it. Now let us talk about withholding, because this is where Carl went wrong, and it is where millions of retirees go wrong every year. When you were working, your employer withheld taxes from your paycheck based on your W-4. It was automatic. You probably never thought about it. When you retire and start receiving a pension, the system changes. Your pension payer does not use a W-4. They use a different form. It is called Form W-4P. The P stands for pension, and it is your responsibility to fill it out and submit it to your pension payer. Here is the problem. Many retirees never submit a W-4P. They do not know it exists, and when you do not submit one, the law requires your pension payer to withhold taxes as if you are single with no adjustments. Think about that. If you are married, if you have deductions, if you qualify for the new enhanced senior deduction of $6,000. None of that matters if you have not submitted a W-4P. The default assumes you are single with nothing else going on. For most married retirees, that default is significantly wrong. It can go either way. The default might be too much, meaning you are over withholding and giving the government an interest-free loan with money you could be using to pay your bills. Or it might be too little, meaning you are under withholding and heading for a surprise tax bill in April. AARP calls this one of the 8 costliest tax mistakes retirees make. Their experts say, and I am quoting, "You might be having a minimal amount of tax withheld, but not enough. So when we do the return, there's very little taxes prepaid, and that could generate a problem." Here is what you need to do. Go to the IRS website. Search for the tax withholding estimator. It is free. It is at irs.gov W4 app. Enter all of your income sources, your pension, your Social Security, any investment income, any part-time work. The tool will tell you exactly how much should be withheld. Then download the current Form W4P from irs.gov. Fill it out based on the estimator's recommendation. Send it to your pension payer. You can submit a new W-4P at any time. There is no limit. If your situation changes, submit a new one. And there is good news for this year. The 2026 version of Form W-4P now includes specific lines on the deductions worksheet for the enhanced senior deduction of $6,000, the additional standard deduction for being 65 or older, and the increased SALT deduction. If you qualify for these, you can reduce your withholding to account for them and keep more of your pension in your pocket each month. Now let me talk about something that pension recipients especially need to understand: the pay-as-you-go rule. The United States tax system requires you to pay taxes throughout the year, not just in April. Throughout the year, when you were working, your employer handled this for you through paycheck withholding. You never had to think about it. In retirement, it is different. You might have 3, 4, or 5 different income streams: pension, Social Security, maybe an IRA distribution, maybe some investment dividends, maybe rental income, and the withholding from your pension may not be enough to cover the tax on all of that combined income. When that happens, you have 2 choices. You can increase your pension withholding by submitting a new W-4P, or you can make quarterly estimated tax payments directly to the IRS using Form 1040-ES. Estimated tax payments are due 4 times a year: April 15th, June 15th, September 15th, and January 15th of the following year. A lot of retirees do not realize these quarterly payments are an option. They think estimated payments are only for self-employed people. That is not true. Anyone who owes taxes that are not covered by withholding should be making estimated payments. If you do not pay enough throughout the year, the IRS charges an underpayment penalty. To avoid the penalty, you must pay the lesser of 90% of your current year's tax or 100% of your prior year's tax. If your adjusted gross income exceeded $150,000 last year, that threshold goes up to 110% of the prior year's tax. There is one small grace note. If you owe less than $1,000 when you file, there is no penalty regardless. And here is something most retirees do not know. There is a special waiver for people who recently retired. If you retired after reaching age 62, or if you became disabled during the tax year or the year before and the underpayment was due to reasonable cause, the IRS may waive the penalty. You request this waiver using Form 2210, but do not count on the waiver. The far better strategy is to get your withholding right from the start. Use the IRS tax withholding estimator. Update your W-4P. Or set up quarterly estimated payments. Do it now. Do not wait until April. Now I need to warn you about something that trips up retirees who receive a lump sum pension payout. This is the 20% mandatory withholding rule. If you are offered a lump sum distribution from your pension, meaning the plan wants to pay you the entire value at once rather than monthly payments, you need to understand this rule. If the plan sends that check to you personally, they are required by law to withhold 20% of the taxable amount for federal income tax. This is not optional. You cannot waive it. You cannot ask them not to do it. 20% comes off the top. Now, You have 60 days from the date you receive that check to roll it over into another qualified plan or an IRA. If you complete the rollover within 60 days, the distribution is not taxable. But here is the trap. Say your lump sum is $200,000. The plan withholds 20%, which is $40,000. They send you a check for $160,000. If you roll over only the $160,000 you received, the $40,000 that was withheld is treated as a taxable distribution. You will owe income tax on that $40,000. And if you are under 59 and a half, you may also owe a 10% early distribution penalty on top of that. To roll over the full $200,000 and avoid all taxes, you would have to come up with $40,000 from your own savings to make up the difference. Then, when you file your tax return, you claim the $40,000 that was withheld as a credit, and you get it back as a refund. But you have to have that money up front. The far simpler option is a direct rollover. You tell your pension plan to send the money directly to your new IRA or qualified plan. When they do a direct rollover, there is no 20% withholding, zero. The full amount transfers, no taxes withheld, no 60-day deadline to worry about. Your plan administrator is required by law to give you a written explanation of your rollover options before any eligible distribution. It is called the 402F notice or the safe harbor explanation. Read it carefully. And if you have any doubt, choose the direct rollover. It eliminates the problem entirely. There is another pension-specific rule that I see retirees lose money on all the time. It is called the age 55 exception. Normally, if you take money out of a retirement account before age 59 and a half, the IRS charges a 10% early distribution penalty on top of the regular income tax. That rule applies to IRAs, 401ks, and pensions alike. But pensions from qualified employer plans have a special exception. If you separated from service with your employer during or after the year you turned 55, you can take distributions from that employer's plan without the 10% penalty. For qualified public safety employees, the age is even lower. It is 50. This is an incredibly valuable exception for people who retire early. It means you can access your pension between age 55 and 59 and a half without paying the penalty. But here is the trap that catches people. If you roll that pension money into an IRA before you take distributions, you lose the age 55 exception. Gone. Once the money is in an IRA, the only way to avoid the 10% penalty is to wait until 59 and a half, or qualify for one of the limited IRA-specific exceptions. This is one of the most expensive mistakes early retirees make. On a $100,000 distribution, the penalty is $10,000. Money that would have stayed in your pocket if you had taken the distribution directly from the employer plan. If you were affected by WEP or GPO, this is wonderful news. You may already be receiving higher monthly Social Security payments. You may have received a retroactive lump sum payment. But here is what most people celebrating those higher checks are not thinking about: the tax consequences. Remember the cascade effect I explained earlier? Your pension pushes your Social Security into the taxable range. Well, now your Social Security is higher, which means your provisional income is higher, which means even more of your Social Security may now be taxable. And that retroactive lump sum payment, it is generally treated as income in the year you received it, which for most people is 2025. If you received a large retroactive payment, that one-time spike in income could push you into a higher tax bracket and cause a significant tax bill. This $3,000 is excluded from your income entirely. It is not a deduction. It does not go on Schedule A. You simply report the lower taxable amount on line 5B of your Form 1040, and you check the PSO box on line 5C. Most retired public safety officers do not know this exclusion exists. Most tax preparers miss it. That is $3,000 of income you should not be paying tax on. In the 22% bracket, that is $660 a year. Over 10 years, that is $6,600. If this applies to you, bring it to your tax preparer's attention. Show them IRS publication 575. The section is called Insurance Premiums for Retired Public Safety Officers. In the year Frank died, Dorothy was able to file a joint return. The standard deduction for a married couple filing jointly was $31,500. The tax brackets were wide, the math worked out. But this year, Dorothy has to file as single. Her standard deduction dropped to $15,750. Her tax brackets compressed. Her income dropped slightly, but her deductions were cut nearly in half. The result? Dorothy's tax bill nearly doubled. She owed money for the first time in her life. This is the survivor's tax trap. When a spouse dies, the surviving spouse eventually must file as single. The standard deduction is roughly cut in half. The tax brackets become narrower, but the pension income and Social Security income may decrease only slightly, if at all. The survivor ends up paying a significantly higher effective tax rate on roughly the same total income. There is a small buffer. If the surviving spouse has a dependent child, they can file as qualifying surviving spouse for up to 2 years after the death. This filing status gives them the same standard deduction and brackets as married filing jointly. But most retirees whose spouses pass away do not have dependent children at home, so they go directly to single filing status. Here is the action step. If you have recently lost a spouse, or if you are the healthier spouse in a couple and you are thinking ahead, update your Form W-4P immediately after a spouse's death. Change the filing status, adjust the withholding. Because the default withholding that was correct when you were married is almost certainly wrong now that you are single. And if you are planning ahead, consider strategies like Roth conversions in years when your income is lower, which can reduce the size of future required minimum distributions and the tax burden on the surviving spouse. Talk to a qualified tax professional about this. The time to plan is before the loss, not after. Let me bring everything together. If you have a pension, the IRS treats you completely differently from retirees who live only on Social Security or Roth distributions. Your pension is taxed as ordinary income with no special exclusion threshold. It pushes your Social Security into the taxable range. The withholding system uses a separate form that most retirees never update. The rollover rules carry a mandatory 20% withholding trap. The early distribution rules have a pension-specific exception that you can lose permanently by rolling into an IRA. And when a spouse dies, the tax math can change dramatically against the survivor. Every one of these rules is documented in official IRS publications. IRS Publication 575 covers pension and annuity income. Publication 915 covers Social Security taxation. Publication 505 covers withholding and estimated taxes. Publication 554 is the tax guide for seniors. Form W-4P controls your pension withholding. Form 1099-R reports your pension distributions. And the IRS Tax Withholding Estimator at irs.gov. The W-4 app is free for anyone to use. Now here are the 3 actions I need you to take. Step 1. Check your withholding today. Go to irs.gov W-4 app. Enter all of your income sources. See if your current withholding matches what you actually owe. If it does not, download Form W-4P and submit a corrected version to your pension payer immediately. Step 2. Find out if you have cost basis in your pension. Contact your plan administrator. Ask whether you made any after-tax contributions during your working years. If you did, make sure your tax preparer is using the Simplified Method worksheet to recover that basis tax-free. If Box 9B on your Form 1099-R is blank, do not assume you have no basis. Ask. Step 3. If you have multiple income sources in retirement, pension, Social Security, IRA distributions, investment income, run the numbers for quarterly estimated tax payments. Use Form 1040-ES. Do not rely on pension withholding alone to cover your total tax obligation. The penalties for underpayment are real, and they add up. I want to leave you with one final thought. The rules I covered today are not opinions. They are not predictions. They are the actual law, published by the IRS, documented in official publications, and they change, sometimes in the middle of the year. The problem is, the IRS does not call you when something changes. Your pension plan does not send you a warning. And the Social Security Administration, as we saw with the WEP and GPO repeal, sometimes sends information that has to be corrected later. You have to stay informed, and you have to take action. That is why I built something for you. In the description below this video, you will find a link to join the Global Senior Alerts official WhatsApp channel. When you join, you can download a free senior benefits protection guide that covers everything we discussed today and more. Pension tax rules, Social Security taxation, withholding strategies, estimated payment deadlines, survivor planning, it is all in there. And more importantly, you will get real-time alerts when the IRS changes a rule, when a deadline is approaching, when a new provision takes effect. You will know about it the same day, not weeks later, not after you have already made a costly mistake. Do not rely on the YouTube algorithm to show you the next critical update. The algorithm shows you what it wants to show you. I am June. Thank you for watching. Take care of your pension. Take care of your withholding. And do not let the IRS treat you differently without you knowing exactly what that means. I will see you in the next one.